Hello and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is April 24th, 2021. It is 2:37 p.m. And today I want to talk about uncertainty. Now, I'm fully aware that financial markets by definition are uncertain, and market participants have to make decisions where all the information is not known. And for the most part, I like to utilize technical analysis to help me with that decision making process. So, for instance, setting up reference points, targets, that type of thing. Well, outside of the normal realm of uncertainty that exists in financial markets, there also seems to be currently a certain added uncertainty because we have all of these I guess some would call it exogenous shocks. So, we have COVID and the government response to COVID, which is not uniform. So it's just leading to disparities from one region or one economy to another. And you also have the fiscal response to COVID, which is not uniform, so also leads to disparities geographically and otherwise. Monetary policy, for the most part, has been fairly uniform, which is just accommodation. And especially in the United States, where we see an alignment of monetary and fiscal policy, the expectation for there to be inflation on the horizon, by some measures, have gone up. Now, inflation by itself is a good thing. Too much inflation, of course, is a bad thing, but I think from the position of most central banks, to see an increase in inflation is not such a bad thing because that they have the tools to combat. They can simply tighten monetary policy to help manage investor expectations. The opposite is where they have a hard time when you have disinflation or outright deflation. And the central banks are then tasked with creating inflation, which the last, 10, 11 years, going on 12 years, have shown that outside of coordinated monetary and fiscal policy, monetary policy by itself has a very hard time generating inflation. And in some cases, even when they are coordinated, like with the case of Japan, if the demographic profile has shifted too far in one direction, even with a coordinated monetary and fiscal policy effort, it may still be difficult to generate inflation. Now, uncertainty for me is focused around the equities market. The narrative changes so often, and also the market reaction to different news outcomes fluctuates so much that it makes it somewhat difficult for me to reference and to build targets or expectations for future market action based on recent historical price activity. So, for instance, looking back at a chart of the S&P 500, a significant event that stands out, and I'm referring to a longer term chart, is the drawdown or the pullback in starting last February and playing out into last March. So for 2 months. So a huge drawdown in the S&P 500 compared to other drawdowns. It was a crash. So we saw that flash crash in last February and March, which was completely attributable to the outbreak of COVID. But of course, the Fed and a lot of other central banks were able to step in by the end of March going into April and really bolster financial markets, and then we saw a turnaround and an extension higher. Now, I use the word extension specifically because part of my analysis, I use Fibonacci's, and they're very simple, but they tell a very detailed story. If I think markets are gonna extend higher, I use Fibonacci extensions to set targets for profit taking, targets for reversals, that type of thing. If I think markets are reversing, I use Fibonacci retracements to do the same thing. Set targets, support and resistance, profit taking, loss limiting, that type of thing. Well, being that equity markets have an upward bias, I used that flash crash, that pullback, that drawdown in last May to measure an extension higher. So starting with a low point in March, and then a subsequent consolidation in, let's call it September and October last year, of course. I drew my extension, and I've been using that as my reference point to measure the market move higher. My most recent significant level was the 50% retracement. When it broke that, the market did a little bit of consolidating around it, but I was able to use that as my reference point. And when the market was above the 50% retracement, I would go long, I would buy my calls. When the market dropped below that 50% retracement, I would go short and I would buy puts. Pretty simple strategy. Well, the market broke above it, closed above it, and has been moving higher since this March, so last month. When the market broke above the 50, closed above it, opened above it, and kept trading above it, the next significant level above that was 4,050 on the S&P, which would have been the 61.8% on the extension. And through the month of April, it broke through that significant level and has not necessarily made an effort to retrace back to it. Above that significant level, the next target would be the 78.6 on the Fibonacci, which works out to about 42.95. So we can call it an even 4,300 on the S&P. And as of close on Friday, it was trading at 41.86. So 4,300 is not necessarily that far away. The uncertainty for me is generated around the fact that the market has not necessarily retraced back to the 61.8 or about 4,050 in the S&P, but instead it powered through that level, didn't really pause, and has just kept going higher. Again, equities have an upward bias, so it's completely reasonable that there's just that much momentum and that much conviction behind the move that it can break through one significant level and move right on to the next. But the time frame in which it's been doing it is so short that, based on my relatively short 10 years of market experience, it seems like the S&P 500 is going too far, too fast. Another thing that creates a little bit of uncertainty for me is that when the market gets to the 100% level on the extension, which let's call it 4,600 on the S&P, I basically run out of targets. And I have to find a new way to identify support and resistance levels, profit taking targets, loss limiting targets for stop losses or closing out positions, that type of thing. So that's the uncertainty for me with the equities market at this point. Being that the market blew through the 61.8% on the Fibonacci extension, and it's probably closer at this point to the 78.6 than it is to retracing back to the 61.8. It's completely reasonable that it just keeps powering higher to the 4,300 level. At which point, maybe we can expect a retracement from the 78 back down to the 61. But for now, I took off my hedge position. I've got call options out to the end of the quarter, and I'm watching the market in anticipation of it moving higher. But if it does get to the 78.6, my experience with Fibonacci's is that that level is significant enough that we typically tend to see some kind of retracement from that level. So, as for now, I'm long US equities with the anticipation that at some point, and at some point soon, we get a pullback or a retracement just to confirm support, because basically the price broke through resistance but never confirmed it as support with the 61.8. So that's the trade, that's the leg that I'm looking to capture at some point in the S&P. But as of this week, I had a put position in anticipation of a pullback, and I ended up closing it out, taking the loss on it, simply because the market just has so much momentum moving higher. And there just seems to be so much investor conviction for that market to move higher. Now, speaking of my trading for this week, let's look at the trade book. So, like I mentioned previously, the idea of the amount of monetary and fiscal stimulus that's being pumped into the US economy and the global economy by governments and central banks around the world has me convinced that there is some level of inflation that we can expect to see increased in the future. And anecdotally, you look at some commodity prices, especially in the soft commodities, agricultural commodities. Recent trading patterns on soft commodity prices have all been pushing higher. So looking at corn, wheat, and soybean in particular, looking back over 3 months worth of data, even a year's worth of data, those charts are vertical. They've just been pushing straight up. So those underlying prices feed into the production chain, especially for food, and we can only expect that not just headline prices, but at some point core prices can also start ticking higher. With that being said, I have been looking for medium-term to longer-term plays that can benefit from an increase in inflation. And I've settled on stocks, of course, because of the upward bias due to rising inflation expectations. Gold, because it has historically been viewed as an inflation hedge by some investors. And blockchain. Do I understand it as well as I would like? No. But I understand trading, and I think it's something that's worth trading. As a long-term investment, I'm not sure if investors should be committing significant amounts of their portfolios to it. But on the short to medium term, the level of volatility around specifically the cryptocurrency aspect of blockchain technology, I think it's worth, at least from a trader standpoint, taking a look at it. I have been buying call options, call verticals on gold, laddering them out. Same thing with the SPY. There's been volatility, but this recent trading week, I was able to take profits on gold. I had a vertical spread that, short term, I think I put that position on earlier that week, but that one closed out profitably. I was able to put on another one for next Friday. So basically, my objective is to have a rolling strategy of short-term positions, specifically in gold. So the idea is to have every Friday or every other Friday options that are expiring long gold. Similarly with the S&P 500 through the SPY vehicle, like I said, the baseline position is a call vertical expiring at the end of the quarter. But then in the intermediate, to set up weekly positions or maybe monthly positions to lever up that long position. But it also gives an opportunity, trading opportunities, if there are signs of retracements, pullbacks, pauses, consolidations, that I can also trade other strategies. So I can do hedging, for instance, or just take on outright short positions in the short term and maintaining an overall baseline position of long to take advantage of higher prices due to inflation expectations. I've been trying to focus on other investments, other real world investments. And being that I'm only one person, there's only 24 hours in the day, I've had to split my time. So I have not been able to focus as much on trading and the portfolio investing side of things. So in order to do that, or in anticipation of having to shift time away from it, I had to reduce the number of things that I'm taking on exposure in. Still monitoring most markets, but just not trading them. And one of the markets I've been monitoring, like I mentioned earlier, is the commodities market. And looking at the soft commodities, I'm seeing at least anecdotal evidence that there's upward price pressure from the commodity standpoint. And we're talking about food inputs. So they affect everybody. Looking at the dashboard, there are a lot of mixed signals that I get from the dashboard because the data set is so short. It's only looking at a week's worth of data at a time. And intra-week market correlations shift. Different narratives are picked up by market participants, and it influences their buying and selling. Even though there are long-term relationships that do hold over time, but in the short and medium term, with the market correlations changing, the relationships tend to shift as well. Looking at, for instance, the dollar index. In the short term, all my signals, 4 signals on the dollar index. Looking back over a week, are all pointing short. So the dashboard is highlighting a clear short signal on the dollar. So if the dollar is used as a reference point for the commodities market, we can expect, if the dollar keeps pushing lower, that other commodities should be pushing higher because they are priced in the dollar. The 10-year treasury is an interesting one because this one's flashing mixed signals. The trend on the 10-year treasury is positive over the last week, but getting less positive, but the momentum is negative. So it looks like it's regaining its momentum higher, even though its trend is pointing lower. Just a visual inspection of the price, though, it just looks like it's been trading sideways for most of the week. But then looking at where interest rates are now compared to a month ago, they're a lot lower. Well, not a lot, but they're lower. So you see lower interest rates, higher bond prices, and higher stock prices as well. So once again, you have stocks and bonds roughly moving in the same direction, or at least drifting in the same direction. Stocks more so than bonds, but they're outpacing them. But still, for two asset classes that typically should have an inverse relationship, they do spend a lot of time moving in the same direction. Which again, when you have a lot of central bank activity in financial markets, manipulating interest rates, it creates distortions in prices. So you don't necessarily get clear and accurate signals from markets, but you do get signals from markets. It's just that based on fundamental relationships, the signals may not make sense or they may contradict, but it is technically the market telling you how it sees things. It may be colored by what's happening with monetary policy, fiscal policy. So the actual relationships, cross-asset relationships, are being influenced, but the market data is telling you how the market perceives things. Looking at gold, on the dashboard, looking back over the week, similarly mixed signals in gold. A visual inspection, the price looks roughly flat. The trend on gold is positive, but getting less positive. Momentum just went negative at the end of trading on Friday. With the dollar and gold having an inverse relationship, the anticipation is for gold to put in a floor, bounce higher, to move in line with other risk assets like stocks. And again, as an inflation hedge, so from a fundamental basis, gold has a couple things supporting its price, but short-term price action, it's looking flat to weak. The S&P, like the dollar, is flashing a clear signal higher. Got trend and momentum both pointing higher, as well as my pivot points. They're both pointing to support. So again, there's been a lot of conviction with the move higher. Not completely clear on statistics on market depth, but the conviction seems to be there in the price move. And even on the short-term charts, like on the dashboard, it's signaling a move higher in stocks. Crude oil, a bit of a consolidation pattern. It's still holding above that 60 level, though, which is a long-term support level. So the target higher for crude oil, again, is still at about $77 a barrel. The trend on crude oil is negative, but getting less negative. and momentum is positive. So if it can find a reason or a narrative to move higher, crude oil has more room above it than it does below. But again, if it does break down below that $60 level, which it did recently, I think, briefly, but it did recently, that would lend credence to looking at a short position on crude oil. But I don't think that is a clear signal as to what could happen across the commodity complex. So now zooming out from the short term to the long term. So looking at gold, we'll start there. It seems to be finding support on its regression curve, which is good. It lends credence to the inflation hedge narrative. It's still holding a similar trading pattern, at least on a long-term chart, as the 10-year Treasury. And if gold were to move higher in tandem with the 10-year Treasury, we'll be looking at higher bond prices and lower interest rates. How does that make sense in the face of higher inflation? It doesn't. Okay, so if monetary policy pushes interest rates lower, supports bond prices, then that theoretically should support gold prices if inflation expectations are rising. But then that means that gold prices are responding to the expectation of inflation and not the actual inflationary outcome, because once we get inflation rising past the targets of monetary policy, the policy needs to adjust to that, and raising interest rates would push the bond prices lower. So that setup just seems like it reflects monetary policy holding steady in place of rising inflation expectations. But that relationship would have to break once monetary policy has to be adjusted in the face of realized inflation. With the dollar, we've been here before, and the last time we were here, the price consolidated around that 90.8 level, 90.80, 90.90, 90.70. Never did quite get down to the 50% level, which would set it at about 87, let's call it 87.25. But if we can get down to about 88, which would basically be confirmation that the price is moving lower towards that 50% Fibonacci retracement, then that can confirm higher commodity prices, and more specifically gold. Now, how does that tie into the narrative between gold and the 10-year Treasury? The dollar pushes lower, gold prices push higher, and bond prices push higher in response to monetary policy. Like I talked about previously with the S&P, it just looks like it's on a clear path higher, extending to about 4,300 as a target. I'm not necessarily clear if it retraces and confirms the 44,050 level as support before it gets to 4,300, or if it gets to 4,300 and then retraces back to the 4,050 level, which would constitute a flash crash in itself. But hey, that's what it does. It goes up, it crashes, and then it goes up again. The timing on that one is kind of weird. Not very clear on it, but the expectation of a pullback, that's what the market does. And for the longer term investors, If you're net long, if you're long only, these are just buying opportunities. For the traders, if you can react quickly enough, there are opportunities to take advantage of the volatility, reposition. But if you're just a long-term net long investor, raise capital, because there may be a buying opportunity or a sale sometime in the near future, at least on stocks anyway. Then there's crude oil. Crude oil, similarly to the dollar, it's at a level that it's been before. If it can get above the $68 a barrel level, that could signal a new recent high and leave room for a short move higher to about $77 a barrel, which is the longer term target on crude oil before the market needs to make another decision as to higher or lower in the longer term. But $77 a barrel, if it can break out above $68, would be a good level for consolidation. I'm not necessarily sure whether it will be a supply issue, as in a supply shortage, or a demand issue, as in a spike in demand that pushes the price higher. But looking at the charts, the price has set up support. It is consolidating. So the goal from a trading standpoint is to look for setups for breakouts and trade those breakouts. And again, from the inverse relationship between the dollar and commodities, similarly to gold, if the dollar keeps pushing lower, we can expect support for commodity prices like oil to push higher because they're priced in dollars. Now, that's it for the forecast. This one was a short one, but thank you either way for listening. If you have any questions, comments, or concerns, you can reach out to me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. Again, this is your neighborhood financial economist, Katie Mark, signing out. When in doubt, take profits.